Picture a thriving city, its streets bustling with activity, shops filled with customers, and factories running at full capacity. This is what a healthy economy looks like. But economies, like the weather, have their ups and downs. Sometimes demand surges, leading to inflation. Other times it falls, causing unemployment and recession. This is where monetary policy steps in, a tool designed to manage demand and steer the economy toward stability. Now imagine an orchestra. The central bank, like a skilled conductor, uses monetary policy to harmonize the economy's rhythm. Its primary instrument? Interest rates. By raising or lowering these rates, the central bank influences the tempo of borrowing, spending, and investment. Let's meet Emily, a young entrepreneur running a bakery in her neighborhood. When interest rates are low, borrowing money becomes cheaper. Emily takes out a loan to expand her bakery, buying new ovens and hiring more staff. Her suppliers also see increased orders, and the workers she hires spend their wages on goods and services. This chain reaction boosts aggregate demand, fueling economic growth. Emily's success story is one of many in a low interest rate environment where monetary policy stimulates demand to prevent a downturn. But what happens when the economy overheats? Imagine that Emily's bakery is thriving, but so are countless other businesses. Demand for goods and services outpaces supply, driving prices higher. Inflation sets in, eroding the purchasing power of households. To cool things down, the central bank raises interest rates. Borrowing becomes more expensive, slowing down investments like Emily's bakery expansion. While this may seem like a setback, it's a necessary step to stabilize prices and protect long-term economic health. Let's take a real-world example, the 2008 financial crisis. In the aftermath of the crisis, demand in the global economy plummeted. Businesses closed, unemployment surged, and consumer confidence evaporated. Central banks around the world responded by slashing interest rates to historic lows. In the United States, the Federal Reserve cut rates to nearly zero, encouraging borrowing and spending to revive the economy. This approach, known as expansionary monetary policy, helped restore demand and set the stage for recovery. Monetary policy, however, isn't just about interest rates. Central banks also use tools like open market operations. Picture the central bank buying government bonds. This action injects money into the banking system, increasing liquidity and encouraging lending. On the flip side, when the central bank sells bonds, it pulls money out of circulation, tightening demand. Another important tool is reserve requirements. Banks are required to keep a certain percentage of their deposits as reserves. By lowering this requirement, the central bank frees up money for banks to lend, stimulating demand. Conversely, raising the reserve requirement restricts lending, cooling an overheated economy. Monetary policy isn't without its challenges. Imagine Emily's bakery again. While low interest rates may encourage her to borrow and expand, they can also lead to unintended consequences. If borrowing becomes too cheap, businesses and consumers might take on excessive debt, creating financial vulnerabilities. Similarly, raising rates too quickly can stifle growth, leading to layoffs and reduced consumer spending. Timing is crucial. Monetary policy operates with a lag. Changes in interest rates take time to ripple through the economy. A decision made today might not show its full effects for months. This makes it essential for central banks to anticipate economic trends and act preemptively, even if the data is not yet conclusive. Let's also consider the global context. In today's interconnected world, monetary policy decisions in one country can have ripple effects elsewhere. For instance, when the US Federal Reserve raises interest rates, it strengthens the US dollar. This can make imports cheaper for Americans, but hurt exporters in other countries. Central banks must weigh these global implications alongside domestic goals. Despite these complexities, monetary policy remains one of the most effective tools for managing demand. Its flexibility allows central banks to adapt quickly to changing economic conditions, whether it's fighting inflation, spurring growth, or stabilizing financial markets. Ultimately, monetary policy is about balance. It's a delicate dance, finding the sweet spot between stimulating demand and controlling inflation, between encouraging growth and maintaining stability. For Emily and countless others, the central bank's decisions shape the environment in which businesses grow, jobs are created, and economies thrive. As we reflect on monetary policy, it's clear that its success depends not only on the tools themselves, but also on the wisdom and foresight of those wielding them. Like a skilled conductor, the central bank must listen to the economy's rhythm, making adjustments to ensure harmony. And in doing so, it helps transform the ups and downs of economic cycles into a steady march toward prosperity.